Adam, a question that I get asked often, and I'm just hoping you can shed some light, is if
Sure.
my home burns down, is the Fair Plan just going to cut me a check?
No, that's not how it works. The Fair Plan product specifically is a replacement cost product, which means they will pay the contracted price up to that amount to rebuild the home if you're going to rebuild it in California. Okay. Now, a lot of my clients ask me, or tell me, I should say, if my house burns down, I'm just taking the money and run. I'm going to pay off a loan and split. Well, there's two different schools of thought there. If they're leaving the state, but they're planning on rebuilding in a different state, say Texas, it's still a replacement cost policy with the caveat that there could be a difference in the cost to rebuild. So for instance, the contract price at $300,000, here in California, maybe that's $350 a square foot to rebuild. Let's say in Texas, the same house being built, similar size and materials, is only $250 a square foot. They're not going to pay more than that to give you a similar home. The key to insurance is not to leave the person who's been harmed in a greater or worse position than they were before the loss. They're not going to put you in a mansion when you were living in a standard home. Conversely, if the same client wanted to take the cash, not rebuild, but still staying in California, it becomes what's known as an ACV policy, actual cost value. So whatever it would have cost to rebuild that home at the time of the loss, minus however many years the depreciation home is. So maybe the replacement cost is $300,000 for a home built 30 years ago, but if they're going to cash out here in California and not rebuild, they're going to figure out what it costs to rebuild at the time of the loss and then subtract about 30 years worth of depreciation, which means they're going to get a lot less money than they think they are if they're going to just cash out. So it's very important that clients really kind of know what direction they're headed when they're making these kind of decisions. If they're going to take the money and run per se, they need to understand that they're leaving a lot of money on the table if that's the case, and it might not be enough to pay off a loan. If they have a loan, they're going to be paying out of their own pocket the difference for that gap. So that's where your insurance professionals come in, because we can help advise with that.
Thank you.
Sure.